Morning, everybody. This is Tim Melvin coming to you from down here in Central Florida on what's trying to be a cloudy, overcast day with a chance of thunderstorms. But I can't allow that today. It's been playing catch up all weekend. Last week, just really was not an enjoyable week. We had to go up to the Northeast. There was cold, there was wind, there were snow flurries. We came home with just the time to get sick, and just catching up all weekend. And so we're going to get this week off to a much better start. Going to be a nice sunny day. I'm kind of ordering that up. I've got tickets to the Orioles Tigers down in Lakeland this afternoon, so I'm going to sneak out of here, play a little baseball related hooky. So really looking forward to that. So the sun's just going to have to get its job done down here this morning. Anyway, looking at the stock market, I had this discussion with several people during the week. Where are we? Okay, look, no matter how you measure this thing, the stock market's expensive. Price to book value, price to sales, dividend yield. The PE ratio, according to the handy dandy copy of Barron's this week, is 26. If you look at some of the general indicators that are popular, the CAPE ratio, getting back up there to those 2006, 2007 levels, threatening to approach the 1999 levels. So is the market cap to GDP, the Tobin's Q ratio, the number of absolute cheap stocks in the marketplace are flirting around, again, 2007, 1999 levels. So is the market overvalued? Yes, it is. Should we sell? Probably not. I really, as I look around, there's no real big credit risk in the system. There's some signs of a little bit of weakness as student loans and auto loans begin to tick up a little bit, but they're taking up from a ridiculously low level. So there's absolutely no threat to the system coming from banks. There's some signs of things to worry about in the direct lending market as we're seeing covenant-light loans and being done at interest rates that I don't think compensate for the risk, but they don't pay me for my opinion, but I'll give it to them for free. But again, very slight, no big signs of a wave of defaults or anything that's going to threaten the financial system. Earnings are just, they're just kind of chugging along with the economy, which is, the economy's 2 steps forward, 1 step back. I've been doing this for years. It's a little better than it was. We actually saw wage growth this past jobs report. So lots of positive signs for the economy. Not going to see earnings fall off a cliff, taking stock prices lower anytime soon. So yeah, the market's overvalued, but I don't see any obvious reason for stock prices to go down, and neither do the institutional investors that keep pushing tons of money into the stock market as we move into the year. Now, the biggest threats to the stock market, Xi Jinping in China, Vladimir Putin, both of those just, had extensions put on their reign of power in their individual nations. Both want a bigger role on the world stage, and both are determined to take their share of that role from the United States. There's going to be trade complications, especially with China. That can shake up the market. But as we saw when Trump did the tariffs here a couple of weeks ago, the fear doesn't last very long at all, and then the money just moves back in, keeping stock prices at very elevated levels. Jerome Powell is a huge concern. The new chair of the Fed, he'll have his first press conference this week. We'll be writing about that in the weekly update on Friday for subscribers. If he raises rates more than the market expects, interestingly, Henry McVeigh of KKR just came out and said they see 6 rate hikes between now and the end of 2019. That's 2 more than the market sees, and that could scare folks just a little bit. So rate hikes going up too fast could, in fact, spook the market, cause a broad-based decline. That'd be great for us as small stock investors, I have to say, because 6 rate hikes means the economy is doing very well, loan demand is strong, collateral values remain elevated, so loan quality remains very high, credit conditions are great, earnings will be going up, we'll see higher dividends, higher buybacks, all that kind of fun stuff. Nice boost from tax reform as well. But the rate hikes, and of course, with rate hikes, we would have higher net interest margins, again, expanding and adding to that bottom line. So great news for us, might spook the overall stock market just a little bit and cause some selling. And of course, the Trump administration is always a source of great interest, entertainment, and possible market shocks. But Looking just at financial conditions and earnings, yes, we're overvalued. No, there's no valid reason for the market to sell off here. And until we get a reason, I don't think we're going to see a sustained, meaningful sell off. So, I'm not saying throw caution to the wind. Those who've been with me for any period of time know that I'm a very cautious buyer. We like to buy stocks on sale, down days, and at unreasonable valuations. Speaking of which, we did do a full portfolio evaluation here recently. Spent quite a bit of time on that, got it out to subscribers over the last couple of weeks. And when we look at the portfolio, yeah, market's way overvalued, but our portfolio of 40 some stocks has a 1.14 price to tangible book value, about a 0.97% yield. Our average bank is $793 million in assets. Non-performing assets are just 3/4%, well below historical averages. We have an 11.9 equity to assets ratio in the average bank in our portfolio. So plenty of excess capital, excellent financial condition. Then each stock in our portfolio, a very conservative estimate of 30% average upside to their full takeover value right now. And interestingly, in a world where nobody has skin in the game, 14.67% of all of our banks are owned by the insiders, the executives and directors that are actually running the bank. Gets even better when we get down to our buy list, which was around 20 stocks this last week. Here, the buy list is trading at about 93% of tangible book value, about 1.2% dividend yield, smaller in size. We've been coming down the market cap curve for the last couple of years. We're just 441 million in total assets. Non-performing assets right around 1%, again, well below historical norms. We've got a 12.9% equity to assets, so lots of excess capital here to pay dividends, to buy back stock, or just to make them a more attractive takeover target. We did, by the way, have a 2 takeover week last week with 2 of our portfolio banks being taken over, giving us 5 for the year so far, on target for 20 takeovers this year. That would be fun. Anyway, the average stock on the buy list has about 50% upside to our very conservative estimate of takeover value. Worth mentioning, both of those takeovers last week were well above, 20% or more above our estimated takeover value. So we like happy surprises, so we tend to be very conservative making assumptions and estimating takeover valuations. I'd rather be wrong on the low side than wrong on the upside. There's a surprise, I want it to make me happy, not ruin my day. 22% insider ownership for all the little banks on our list. So with our banks, we have skin in the game. All of our banks pretty much also have activist or bank stock specialist shareholders. So we've got insiders, we've got activists, we've got concentrated focus institutions as shareholders. Really is a win-win. Market's overvalued. We're still finding enough bargains in the small bank space to keep the lights on and make some money in 2018. And we saw the Senate pass its version of DoddFrank reform last week. And lots of folks are going into the nuts and bolts, and this means that, and this means this, and this means that. And none of it means anything at this point, okay? Because the House bill that was passed not too long ago looks very different than the Senate bill. And the Senate has said, the House has said, hey, we're going to have a bigger voice in this. We're not just rubber stamping this bill. Translation, the compromise is going to be difficult. There's going to be a lot of arguing to get a compromise bill to actually place on the president's desk. Now, in the Senate, a lot of Democrats, 17 to be exact, crossed the aisle and voted for the Dodd-Frank reform. Fact of the matter is the Democratic Party needs to be able to point to some bipartisan legislation in this upcoming election, and making things easier for small banks would be a fantastic thing for them to say they participated in. However, Elizabeth Warren and her tribe of anti-capitalists, I guess is what we'll call them, they don't like the bill. They don't want anything about Dodd-Frank rolled back. They'd like to add a few more things to it, in fact. And they've been, publicly kind of shaming the Democrats that crossed the aisle, and they're going to be really working on senators and congressmen in the Democratic Party to back away from the compromise bill and make it very difficult, or as difficult as possible, for the Republicans to pass. Eventually, it'll get done, folks. We will see some regulatory rollback this year. I'm pretty much convinced of that. The president's going to sign it. I don't think there'll be any waffling here. Reforming DoddFrank has been a priority of his from day one. So I'm not going to get into the line item of the Senate bill that passed. There's absolutely no point. When we get a compromise bill, I'll spend a little bit more time talking about it. So we saw something interesting last week. Housing starts declined. They declined quite a bit. Multifamily was really down, fell 26.2%. Building permits also declined. So we had kind of a swell in building earlier this year. We're still, folks, on a per household basis, we're at a 60-year low in new construction. We have this really tight supply situation developing in the housing market, and that's causing prices to move up. We've also got another factor. Costs are moving up. Lumber is at a multi-year high. So are many of the other building products and supplies that are needed to build houses, rising the costs, pushing down the margin. So the builders, they're really focusing on the upper end market because that's where they can hold margin. First-time home buyers, there's almost nothing out there for them in their price range. This is going to eventually create a problem in the housing market. We'll see how it kind of all plays out as the year goes forward. We'll be watching that. But for now, housing starts are declining. A lot of that is a price issue. We'll see what happens as the year develops. Right now, housing's still fine. Real estate prices are continuing to move up. That's fantastic news for us, again, as small bank stock investors. So it means collateral values are holding very firm. But we're going to really keep an eye on those new housing and existing home sales numbers as we go forward. And that's really about all I have this week. There's been no big developments. We had the Russia election. Xi Jinping was appointed president for life and probably beyond. I don't know. So China and Russia are the two hot spots that we will be keeping an eye on because they are potential market disruptors. Trade war with China has honestly terrifying economic consequences at this point. So we'll don't see anything in the short run, but those are two of the biggest factors that could move the market. And besides, the news junkie in me finds it to be just absolutely fascinating to follow, read, and ponder over the occasional glass of wine in the evening. So anyway, going out today to watch the game. Tillman's getting the start. He's been terrible so far in spring training. I think his earned run average is 18. Dylan Bundy, not looking good, got shelled again the other day. The flip side of that, Cashner, the new pickup, has looked fantastic. Kevin Gausman had a really rough first outing, but he settled down and has looked pretty good the last couple times he took the ball to the mound. The bullpen looks excellent. None of the guys that they bought in as potential starters has done much to impress me so far. So the position players look great. Machado, Jones, Scope, all having fantastic spring trainings. But I'm not sure that's going to be enough. The lineup looks fantastic. Should be enough to keep it interesting. Maybe get us to third, but something's going to have to change in that pitching staff for us to even have a chance of competing with the New York Yankees in that murderer's row lineup of theirs. And world-class bullpen. Boston's pitching is fantastic, and their position players we don't talk a lot about, but they're not exactly awful. So if we're going to compete with Boston and New York, our pitching has to improve dramatically, very quickly. That's a tall order. We'll see what happens. I'm a huge Orioles fan, so we're hoping that it does. But I'm also a long-time Orioles fan, so I know better than to be too optimistic. So anyway, did spend some time on the bench last week. Thursday and Friday was pretty much out of it. Same was true for Wednesday, but we got a little bit of work done and we spent some time on the airplane. I gave myself a hiatus from nonfiction reading last week. We're going to pick that back up this week. But last week, on the fiction side, we had a pretty good week. Caribbean Rim, the new Doc Ford mystery by Randy Wayne White was out. If you haven't read that series, this is just a fun, interesting, and occasionally even informative set of mystery novels set down here in Florida over in Sanibel Captiva. Great characters, fantastic writing. Randy Wayne White is one of my absolute favorite writers. If you haven't ever checked it out, please do check it out. If you're a fan, the new one, just as consistent as all the rest. Excellent read. You'll enjoy it. Walter Mosley, another fantastic author, is out with a new book, and he's got new characters this time, set in New York instead of Los Angeles. Really good book, folks. Just a fantastic read. Highly recommend it. And the latest in the Dan Coast series by Rodney Reisel came out. Just pure fun read. Again, detective story set in Florida. Kind of addicted to those. Huge fan. But anyway, all those are out. We're going to pick back up on the nonfiction side. We had started Skin in the Game by Nassim Taleb. We will finish that week because this week, because I love reading his writing, so we'll plow right through that. Then we're going to start on Thinking in Bets by Annie Duke, the professional poker player. A lot of my friends have highly recommended this book to me, especially those of a more quantitative bent. So really looking forward to that. Poker, decision making, markets, some of my favorite topics, all covered in the book. So I can't wait to read that one. So anyway, that's about all I've got. I've got some errands to finish up around here. Need to get a little more coffee in me. Then I've never been to the Detroit Tigers facility over there in Lakeland. I've been trying to go for several years. Got my tickets, got a little premium parking pass. Pretty excited about it. Going to get myself a big old hot dog and a Diet Coke and watch some Orioles baseball this afternoon. So if there's any developments during the week, I'll get back to you. Other than that, I'll talk to you guys next week. Just a quick side note. The Community Bank Stock Investor monthly issue was delayed by a few days. It's usually out by now. We should have that for you in the next day or two. So look for that in your email inbox if you are a subscriber. If you are not a subscriber, it's $199 for the year. We have a fantastic track record. It's been around 20% a year as far as gains on the stocks that we mentioned in there. We've got some great guest commentary every month, and we've done a pretty good job of covering the space and making our subscribers money. So get over to marketfly.com, search for me, Tim Melvin, Community Bank Stock Investor, $199 a year, hard to go wrong. Sign up, and we look forward to having you as a member of our little community. Anyway, I'm off to watch some baseball, guys. Have a great week.